about 3 years, and we were able to increase the NOI significantly.
If you're investing, investors will.
The podcast for all things real estate investing.
So, welcome back to another episode of Investor One-on-One. Today, we have the co-founder and managing partner at Granite Towers Equity Group, an investment firm that owns over 3,100 multifamily units and focuses on cash flowing properties that beat most traditional investments. Before real estate, he spent over 10 years as a high net worth insurance agent for a Fortune 500 company, helping clients protect millions in assets. That experience gave him a deep understanding of risk, and today he uses that to scale to make smart, safe decisions for the Granite Towers portfolio. He's also the co-host of Keeping It Real Estate podcast and the co-author of 4 Steps to Successful Passive Investing. Michael Roeder, it's great having you on. Welcome to the show, man.
Thanks so much for having me on, and I'm excited to be here.
Perfect. So let's just start with your personal journey and how you got into the industry, and then we can lead to, how did you start Granite Towers and why did you start that?
Yeah, definitely. So I got hit with the real estate bug back when I was about 20 years old. My girlfriend back then, she's now been my wife for 16 years. We decided that we were going to buy a 4 bedroom house built in 1924 right next to campus. And we lived in one of the bedrooms, rented out to 3 other bedrooms. So we house hacked that first house and just kind of fell in love with basically living at that property for free and having a little bit of cash flow. And so we eventually turned that property into a full-blown rental property, continued to accumulate a handful of single-family rental properties, and we went through every avenue. We used a 401k loan, a home equity loan, personal loan from individuals that we knew, just to really get a start building our real estate portfolio. And back then, it was 2008, 2009 when we got our start. My original goal was to have 100 single-family rental properties. Didn't really have a goal around passive income, knew that I wanted to be financially free, and it was going fairly slow. And, thinking back to that time, I was doing all the management, was doing the evictions, doing all the marketing, doing all the maintenance. So that way the deals could cash flow. And I was starting to experience a little bit of burnout because I had a corporate job, down in Minneapolis, was commuting over an hour. And then, I would get back home, take care of my kids for a bit, and then run up to our rental properties, which was another hour the opposite direction. And at that time, my business partner, Dan, he was a professional snowboarder, did that for about 13 years. He was advised to offset his income by buying apartment complexes. So that's what he was doing in tandem with me doing the single family rentals. And, we had been in close contact, really good friends, and we decided to partner and pool our funds together and start buying apartment complexes so that way we really could scale our real estate portfolios. And that was back in about 2014, 15 when we started doing that together.
That's amazing, man. And today, what markets do you guys focus on?
Yep. So we have 3 markets that we're really honed in on. Dallas, Fort Worth, which is about 70% of our portfolio is there. We have just over 3,000 units. And then Nashville is a second market. I'm actually in Nashville today. Really robust growing market here as well. And then Minnesota is our third market. That's where I currently live. That's where Dan's from. We know the ins and outs of every nook and cranny of Minnesota. So that's a market that we invest in as well.
All amazing markets. And like you said, you're from Minnesota. That's probably why you guys started there. But let's say, Nashville and Dallas, how did you guys choose to go into those markets back then?
Yeah, we were looking to, get additional deal flow. So one of the problems that we experienced early on up in Minnesota is we just didn't have enough deals coming to our plate that we could take a look at. Up in Minnesota, there's a lot of long-term holders, so you don't see as many transactions up there. Whereas Dallas, Fort Worth, it's really the mecca of multifamily real estate. Lots of deals turning, lots of opportunity to look at multiple deals. So we went from looking at, maybe 20 or 30 deals a year to underwriting over 300 deals a year when we expanded to, a couple other robust markets. But you look at Dallas, Fort Worth, no state income tax, landlord friendly, business friendly, ton of Fortune 500 companies. It's growing rapidly. So we really, were drawn to that market at that time. And then Nashville, we had a third partner that had done a lot of work building out relationships, getting to know the market, and he brought us into Nashville. And so we started buying properties about 4 years ago in Nashville.
Really cool. And are there any markets that you guys are looking to expand to, or you guys just want to focus on those three for now?
Just focusing on those three. And that was another mistake early on is we were opportunistic. So we bought a deal in New Mexico, we bought a deal in Alabama, Wisconsin, Minnesota, and you find yourself, creating problems because you need to have a pulse on those markets. You need to have multiple vendors. You need to have multiple property management companies that you have really good relationships with. You're doing site visits. So I would recommend anyone listening to this, if you're looking to get into the multifamily arena, whether it's passively or actively, just try to hone in on one or a couple of markets, especially when you get your first start.
So for the people who are looking to get into investing into multifamily, what kind of return structure do you offer investors and why?
Yep. So we keep our deals pretty simple as far as the structure. What we've been doing recently on our most recent deal is we do an 80-20 split. So 80% of the equity and the cash flow goes to our limited partners that are looking to invest in the projects. And then after we hit a certain return metric, usually about 16 to 18% annualized, then it goes to a 70-30 split. We've also just implemented a preferred return on our offerings. Not sure if we'll do that on every offering going forward, but it's a 7% preferred return. So that way, all the initial, profits, cash flow, they're going to that 7% return metric. And then we start, to take our split on our deals. So we're very simple. The other nice thing is if there is a refinance, all limited partners continue to keep their same equity position in the deals, which is really, really advantageous for limited partners. There we go.
So, you're really a numbers guy and you guys kind of invest in different places, have different deals. What's one deal that you guys have done that best represents your investing philosophy?
Yeah, that's a great question. I would say, the first deal that we did down in Dallas, Fort Worth, we bought a property, fairly small, a little bit under 100 units, and it was a value add project in a growing area, really good submarket, really good, tenant base as well. And we held that project for about 3 years. And we were able to increase the NOI significantly. A couple of things that we did on that project is we relocated the office. It was in a two-bedroom townhome. We relocated it to a smaller section of the property that used to be a maintenance room. And so we were able to, rent out that two-bedroom townhome for a little bit under $2,000 a month. We put in a new laundry center. We renovated, almost 100% of the units. And that project, our original projections were about a 14% annualized return, 70% over a 5-year period, and we ended up achieving about 103% annualized return, over a 3-year period. So people, tripled their money over a 3-year period. So, that's I wouldn't say typical returns, but that was a nice home run project for us. And we bought that property in about 2019 or so.
Those are some amazing numbers. And you're that multi-family guy. And for the people hearing this right now, we have a lot of single family and people who do other things. How do you see multi-family performance evolving over the next year or 2 years? And why multi-family for whoever's hearing this?
Yeah, those are a couple of great questions because the situation that we're sitting in right now is we're at the bottom of the multifamily real estate cycle, in my opinion. So you've had interest rates ramp up significantly over the last couple of years. You've had a lot of institutional capital and retail capital pause their investment. So you're in a situation where pricing has dropped by about 20 to 30% in the multifamily space because of that. And right now, things have stabilized. It seems like interest rates are going to be cut. I don't know if they're going to be cut in the next few months or if it's going to take a year, but it does seem feasible or, plausible that that's going to happen in the near term. Also, you're seeing a lot of capital flow back into the multifamily space. So what that's going to do is it's going to compress cap rates, which means that values are going to go up. So we're really bullish. We're more excited than we have been in the last few years to jump in right now. But it's got to be the right asset. So we've made some adjustments to, where we're buying, what type of submarket, the vintage property that we're buying, and whatnot. But back to your question, or you had asked, why multifamily now? There's a few big reasons. So first off, the affordability gap is massive. It's close to the largest that it's ever been. So to own an actual home and pay for the mortgage and everything that goes into it versus renting, it's about $1,300 to $1,400. So there's a big gap. The renter demographic, more and more people are becoming renters in today's environment. So that's a huge plus. And then, you take a look at rent growth. It's been pretty stagnant for the last couple of years because of interest rates where the economy is at. And then also there's been a lot of oversupply in some of these hot markets. Permitting has fallen off a map. So permitting, new construction has dropped by about 50%. So you look out towards the end of 2025, 2026, 2027, and there's going to be a lot of good rent growth, a lot of increased occupancy rates because there's not enough supply. So we really, really like that. And you want to be paying close attention to the submarket that you're investing in, but nationwide, there's going to be an undersupply problem, which is always a good thing for multifamily investors.
Wow, that's really interesting. I know we spoke a little bit about 401ks earlier. How can individuals and investors use their retirement funds to invest in your deals?
Yep. So there's a couple of different ways. So typically you're going to need to transfer your funds over to a different intermediary that handles self-directed investment. So you'll find a company like Horizon Trust or Quest Trust that allows investment into real estate. If you have a typical IRA, let's say through Fidelity or Goldman or whatnot, it's likely that they're not going to allow you to invest in alternative investments. So make sure that you can invest into alternative investments. If you can't, then you need to shift it over to another provider. There should be no tax hit. You don't touch the money. It just needs to be transferred over, which takes a couple of weeks. If you have a 401k, that's feasible too, as long as it's not with your current employer. So if you're currently employed by that person, you probably can't shift it, to a self-directed IRA. But if it's an old 401k from a previous employer, you should be able to shift that over to a self-directed IRA and then funnel those funds into real estate, or you can even do cryptocurrency, other types of investments as well, which is really nice.
For sure. And then for the people who do have the cash, what's the number one thing that passive investors should understand before placing their first $50,000?
Yeah, so I would say it depends on which route you're taking. So if you're going to passively invest it, get to know the individuals that are putting together the projects, make sure that they have the time, the bandwidth, the knowledge to create a successful investment. One thing that we've seen over the years is, there's a lot of syndicators out there that are doing similar to what we're doing. They're putting together projects, but they're also working, a full-time gig where they're working 50 to 60 hours a week. And it might work okay for the first project, but if you get two, three, four projects under your belt, that can be really hard to balance, if you don't have full-time capacity to put towards that investment, or if you don't have a team built out. And then I would get to know the area that you're looking to invest in. That's important as well. And then also the numbers, just understand what you're looking at. And if you don't understand, ask questions and make sure to get a second and third set of eyes, on the underwriting of the deal, because the slightest adjustments to rent growth or vacancy rates or the reversion cap rate or the rental rates, they can make a big difference on the returns. So you just want to make sure that the underwriting is conservative and that you feel really good about it.
I agree. And I know we spoke a lot about the positive of this kind of investing, but are there any certain types of deals or markets investors should be avoiding right now?
Yeah, so I would say any market that is extremely tenant friendly, I would be hesitant. Now, obviously, people can make good money, but we were at a mastermind recently, and there was a couple individuals that had properties out in New York, and it was taking them years to get the residents out of their properties because of the really strongly tenant friendly landlord laws that are in place in that state. So I think you just need to be careful there because it really can impact your bottom line. So you need to understand how long is it going to take you to get residents out? Is there any rent control? What type of growth is in that market? And then also what type of job diversity, is in that market as well. I think about a case study. We invested in a property in Carlsbad, New Mexico about 5 years ago, and COVID hit, oil went negative. It was an oil market, and we saw a mass exodus of jobs in that region, and it significantly affected our occupancy rates and our rental rates. So when you're looking to invest, I would strongly recommend, investing in a diverse job economy as well.
For sure. And I know you told me a little bit that you started with single family and then you met your partner and then you guys built this amazing company. for someone that's investing right now, and scaling is a very hard part of this business.
Mm.
In your experience, and what advice do you have for someone that wants to kind of shift from single family to multifamily, and how can they do that?
Yeah, so I would say first off, either find a really good mentor to help you out with jumping into the multifamily space, or piggyback on someone else that has already done it and been successful, whether that be, passively investing with them or partnering with them. Even if you have to work for free for a little bit, those lessons are going to be invaluable and eliminate a lot of mistakes that you would likely make. I think back to like our first apartment complex that we bought, 20 unit. It wasn't big. Dan had bought a couple apartment complexes before that, a 12 unit, a duplex, a couple other smaller deals as well. And the mistakes that we made were, really good learning lessons, but like we lost a lot of cash on those first couple of small apartment complexes because we didn't know exactly what we were doing. And if we could have instead passively invested those funds with a good operator and learned from them, what they were doing along the way, or partnered up with someone that had more experience and gave them some equity, I think we would have made out much, much better.
And how did you fund that first deal?
Yeah, so the first apartment complex, we had three people in it, myself, Dan, and one other friend of ours. For myself, a portion of it was cash, and then a portion of it was a home equity loan. So I think we each came up with like 160,000 or so a piece. And so that's how that first deal was funded. And then we got about 75% leverage from Fannie Mae, which is an agency loan that we put in place as well.
And I don't know if I've asked this, but how are you guys also finding your deals?
Yeah, so we in the space that we're in, we typically focus on anywhere from 100 to 400 units per acquisition that we do. And in that space, you have a lot of sophisticated buyers, a lot of sophisticated brokers out there. So we're typically getting our deals through sales brokers. Usually, we're able to pick them off market, so they do come through those brokers, but they're not fully listed. Or if there's a fully listed property, we're usually able to preempt it, so that way it doesn't get bid up in a bidding war. So those are typically the ways that we're sourcing our deals.
That's amazing, man. Your story is truly amazing. With all the success, you probably had a lot of failures along the way and lessons that you learned. And I'd love to hear something that a hard lesson that you learned early in your investing career that you'd like to share with our investors, or any quote or phrase or something like that.
Yeah, for sure. I would say, let me bring you back to one of our first investments that we made, that 20 unit apartment complex. We invested in our hometown in Minnesota, small tertiary market, because that's what we knew and that's what we felt comfortable with. Um, what happened was the college, which was very close to the asset, the enrollment ended up plummeting because of some of the immigration in the city and some of the things that were going on in the city. And so what happened was all of the student properties around that campus started converting to family apartment complexes or apartment market rate apartment complexes. And we didn't realize that that was going to happen. Like it wasn't something we would have ever guessed. And so what happened was our occupancy went down significantly. Our rental rates, we had to drop them significantly. And it impacted a significant amount of communities and apartment complexes around that campus. And that campus hasn't come back to today. And so that, we ended up, not taking a bath on it, but we didn't really make any money. And we held that property for about 4 years. And it was a lot of sweat equity, a lot of work. And we pretty much broke even because of that. So looking back, just investing in the right market that has growth potential, that's landlord friendly, that, yeah, that you have all the wins at your sales is critically important.
Well said. And to kind of conclude this, what's next for you on a personal journey and for your business?
Yeah, so personal level, I have my wife Brianna, and then we have two daughters that are 9 and 13, and so just continuing to get them involved in the business and entrepreneurship is really, really important for us, which has been a lot of fun. We bring them on property site visits, due diligence, networking events, which is phenomenal. And then on the business side, we're looking to go from about 3,000 units to 12,000 units over the next decade. And so we're going to continue down the path of multifamily, continuing to build out our team. And then we also have a triple net lease investment arm of our company as well, that we started up about 2 years ago. And so we've been, delving into that space as well.
That's amazing, man. I love it. I love the vision and can't wait to see this growth. So thanks again, Michael, for sharing your insights and experience with us today. It's been a pleasure having you on Investor One-on-One. If our investors want to connect with you or learn more, how can they find you?
Yeah, thanks again for having me on, Or. And to find us or more information about us, go to Granite Towers Equity Group.com. We have a contact us page. If you fill that out, we'll send you over our free passive investment tracker, our ebook about passive investing, and some other goodies as well. So make sure to take a look at that. Granite Towers Equity Group.com.
Amazing. And to everyone watching, thanks for tuning in and stay connected for more interviews with the nation's top investors. Thanks, Michael.
Thanks, Or.